Your card declines at the grocery store, not at a restaurant, not somewhere you could brush it off later, at the grocery store with a basket of things you calculated before you put them in. Eggs, bread, the store brand pasta that was on sale. You did the math in the aisle. You were $14 under your balance, except you weren't because the gym membership you meant to cancel 3 months ago processed overnight. The account that was positive at midnight is now negative by $11. You put the eggs back, you keep the pasta, you leave without looking at the cashier. The fee arrives before you get home, $35. You overdrafted by $11. The penalty is more than 3 times the debt. The bank does not know about the gym membership. The bank does not know your paycheck comes Thursday. The bank knows one number and responds to that number automatically, without judgment, without consideration, and without exception. You call the number on the back of the card. You wait 19 minutes. A voice appears, polite and scripted, and tells you the fee cannot be waived at this time. You ask what that means, at this time. The voice says the system makes that determination and cannot be overridden. The system does not explain itself. The system charged you for not having enough money. The system considers this closed. Somewhere at the bank's headquarters, a quarterly report records your fee alongside thousands exactly like it under the line item, non-interest income. That is the phrase banks use for revenue generated from people who are struggling. They collected $7.7 billion of it in a single recent year. Most came from a small category of accounts that overdraft repeatedly, not because those account holders are irresponsible, because the math of being broke is recursive. The fee is why the buffer never grows. The bank did not design this to be cruel. The bank designed this to be profitable. The distinction matters less than you think at the moment your card declines in a grocery store. You are not a customer at this level. You are a fee event, automated, logged, and forgotten. You pulled the account back from the negative. You skipped the bar on Friday and the barbershop for 2 weeks. You sold something you did not want to sell. You have $220 and it feels like winning something. The bank responds to $220 the same way it responds to $0. The maintenance fee hits on the 15th. $12, withdrawn automatically because your average daily balance did not meet the minimum. The minimum is $1,500. You do not have $1,500, so the fee stays. You are paying the bank to hold the money you barely have. The account is earning 0.01% on whatever sits there. That is not a rate. It is the bank's way of not saying zero. While that money sits earning nothing, the bank lends it out at between 8 and 24%, depending on the product. You are a deposit, funding someone else's loan. You are not benefiting from this arrangement. You try to apply for a credit card. The bank approves you for a secured card. This requires you to give them $300 of your own money as collateral. They will then extend you $300 in credit and charge you 26.99% interest on any balance you carry. You are depositing money so the bank can lend it back to you and charge you for the service. The annual fee for this arrangement is $39. You do not take it. Your tire blows on a Wednesday. You do not have $180 for the repair. You Venmo your cousin with a promise to pay it back Thursday and a level of gratitude that feels disproportionate, but is not. You walk into the branch to ask about the maintenance fee. The teller ahead of you is warm with the customer she is helping, laughing slightly, asking about the renovation. When you step forward, the warmth recedes. It becomes efficient. She processes your request in 40 seconds, tells you the fee cannot be reversed, and does not ask if there is anything else she can help you with before moving to the next person. The problem is not that she was unkind. The problem is that she was correct. There is nothing else the bank can help you with at $200. The product suite available to you is narrow and unfavorable, and she knew that before you finished asking. The bank does not see you as a customer at $200. The bank does not see you at all. Your employer sets up direct deposit. $2,400 arrives every 2 weeks, same day, same amount. The maintenance fee disappears. Not because you asked, you did not ask. The system detected the pattern and automatically reclassified your account into a fee-exempt tier. The same $12 that drained your account for the past year just stopped existing. No notification, no explanation. The algorithm decided your income pattern now matched the profile of an account worth keeping for free. A credit card offer arrives in the mail, not a secured card. A real card with a $2,500 limit and your name on the front. Pre-approved. The same institution that required you to hand over collateral to access credit 8 months ago is now offering it without collateral, because the risk calculation has shifted. You get approved. You do not use it much, but having a card you do not need feels different from needing a card you cannot have. The loan you apply for, $4,000 to repair the car, comes back approved in 36 hours at 12.5%. That is a real rate for a real loan, not a penalty disguised as a product. The process worked the way the commercials said it would. You walk into the branch and the teller says "Good morning" before you reach the counter. Not the warmth she gives the customer with the large balance, but not the 40-second efficiency she gave you at $200 either. Something in between. Recognition without warmth. Service without effort. The middle ground where most people live their entire financial lives. You are profitable now. Not valuable yet. Profitable. And profitable at a bank is the beginning of being visible. You log into the app and the credit limit has changed. You did not apply for an increase. The system ran its periodic review of your account, assessed your repayment history and growing balance, and extended more credit because your profile had demonstrated you did not need it. You pay on time. You do not carry a balance. You are a low-risk customer, and the bank rewards low-risk customers with more rope. A real person calls you. Not a call center, not an automated prompt. A person with a name and a direct line who says they have been assigned to your account. They want to schedule 15 minutes to understand your financial goals. The same institution that kept you on hold for 41 minutes at $200 is calling you first thing on a Tuesday morning. They are not doing this because they like you. They are doing this because your account has been flagged by a retention model as a high-potential relationship. Accounts at your profile tend to grow. The bank wants to be present when they do. Understanding the mechanism behind the call does not make the call less useful. The attention is real regardless of the algorithm that generated it. The rate on your next loan is 6.9%. The same loan that cost you 12.5% at $3,000 in savings costs less now because your risk profile has shifted. The price of money fell. Not because you negotiated. Because accumulated savings change how lenders price you. This is how financial momentum compounds before the numbers are even large. You pay less for everything that requires borrowed money, which is cars and houses and sometimes businesses. The advantage begins here, quietly, at the level of basis points. A fee appears on your statement. You email the person who called you. 3 hours later, it is reversed with a note that simply says, "Taken care of." No form, no hold music, no script recitation, no denial. The same fee that would have required 40 minutes and a flat no at $200 requires one email at $15,000. The policy did not change. Your position within it did. The word appears on your statement. Preferred. On the welcome screen when you log in. On the email signature of the banker assigned to your account. You did not earn the designation. The number did. When your combined assets crossed an internal threshold that is not published on any product page, the system reclassified your relationship tier and the label followed automatically. The branch experience changes. You walk in for a routine matter and someone with an office, not a teller window, approaches you by name and guides you past the waiting area. The same rope line you stood inside for years. You pass it without thinking about it, which is a kind of forgetting that feels like arrival. Your assigned banker knows you mentioned refinancing your apartment lease 6 months ago. He brings it up before you do. He has a colleague in the mortgage division. The colleague calls that afternoon. A competing bank sends an offer. Better rate on a savings tier. You mention it to your banker, not as a threat, just as information. He calls back within 90 minutes with a matched rate and a higher APY. The institution that processed your requests in 40 seconds without eye contact is now competing to keep you. The difference between being processed and being competed for is not a change in the bank's values. It is a change in what losing you costs them. You are not preferred because the bank prefers you. You are preferred because replacing you requires effort. Understanding that changes every negotiation you will have with them from this point forward. The advisor does not send a calendar invite for you to come to a branch. He asks when he can come to your office. He drives there. He brings a leather portfolio with printed reports personalized to your account. The meeting is 90 minutes and he does not pitch a single product. He asks about your goals, your family, your timeline, your tax exposure, your estate plans. He asks what you want to protect and what you want to build. This is the difference between being sold to and being consulted. Products come after consultation, and consultation earns trust faster than any product pitch ever does, which is why the bank trains advisors at this level to never open with a product. The selling has already happened in the act of showing up with the leather portfolio and spending 90 minutes asking questions about your life. You call about a wire transfer that froze. Someone answers on the second ring. No hold music, no script, no escalation. The problem is resolved in the same conversation by someone with the authority to resolve it. The call that would have required 3 transfers and 40 minutes at $200 takes 7 minutes at $500,000. The system did not change. Your access within it did. You are not a customer at $500,000. You are an asset the bank actively works to protect. Private banking is not wealth management with a better label. Wealth management is a product, standardized, scalable, profitable at volume. Private banking is a relationship, and relationships operate outside standard products. Your private banker manages fewer than 25 accounts. Yours is one of them. When you call, he answers or calls back within minutes, not because he is particularly attentive, but because 25 accounts is a number a person can know. He is not working from a screen full of names. He is working from a small collection of relationships whose complexity he has studied. He knows about the acquisition you are considering because you mentioned it over coffee before you had made any decision. He follows up on things you did not ask him to follow up on. This is not warmth. This is professional survival. Clients at this level leave for institutions whose bankers are more attentive. He cannot afford to be inattentive. The mortgage rate on the property you are purchasing is not quoted from a rate sheet. It is negotiated in a phone call between your banker and someone in the lending division who has been briefed on whose account this concerns. The resulting rate is below anything published. The difference over 30 years is not marginal. An investment opportunity arrives in your inbox before it is available below your asset threshold. The bank's deal team sourced it and prioritized it to accounts with the capital and relationship depth to participate. You receive access because of your position in an internal hierarchy, not because of your connections or judgment. You were in the right database. The bank exercises discretion in your favor at this level, not the law, not the regulations. The internal policies that govern approval timelines, fee exceptions, and product access have discretion built in, and that discretion is routinely exercised toward accounts that justify the exercise. The rules do not disappear at 3 million. They develop flexibility. You do not apply for things at $10 million. Things apply to you. Investments are brought before they are public. Deals are structured around your participation before you have agreed to participate. Rates are negotiated before you have asked for a negotiation. The bank has learned the cost of reacting to you slowly and has reorganized the relevant processes to operate ahead of your requests. 3 people inside this institution have performance metrics that include the health of your account. They do not tell you this, you do not tell them you know it, but the math is real. If you moved your assets tomorrow, 3 careers would register the event. The deals that come to you do not exist in any brochure. There is no rate sheet. There is no standard product that fits your situation because your situation has been determined to be non-standard. Loan structures are written for one client. Investment terms are drafted to your timeline. The institution writes sentences that apply to one person, and that person is you. The chief investment officer asks your opinion on a sector they are building a position in. The head of private banking flies out for an afternoon, not to pitch anything but to listen. They are asking what the next generation of services for clients like you should look like. You are shaping the product roadmap of the institution that once charged you $35 for being $11 overdrawn. The same bank, the same systems, the same quarterly reports that once recorded your overdraft as non-interest income now record your relationship as a named asset to be protected. At level 1, you were a number the bank was trying to recover from. At level 8, you are a number the bank is organized around losing. You are the same person at every level. Right now, somewhere, someone is staring at a minus sign on a screen. They overdrafted by $11. A gym membership they forgot to cancel. The fee is coming. They do not know yet that the system processing that fee is the same system that will one day fly someone across the country to ask their opinion on emerging markets. The bank does not change at every level. The bank reveals what it always was. The price of everything inside it, the attention, the rates, the access, the room they put you in, was never about who you are. It was always about what is next to your name.